Lemonade, the fast-growing insuretech business, hyper-growth, is down over 85% from its 2021 high. Investors are wondering how much lower can it go? Where do you find a potential bottom with Lemonade stock, LMND? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Lemonade. And so Lemonade has a noble mission of bringing comprehensive insurance to the masses, whether you're a 25-year-old looking for renter's insurance or a 50-year-old looking for an umbrella policy. Their distinguishing approach is to use artificial intelligence to delight customers with cheaper underwriting, so cheaper insurance, and faster claims processing, resulting in a better experience. And they've grown very quickly. Not only have they grown their customers over time, so you can see their customers grew from 643,000 to 1.4 million, but these customers are also paying more, using their different products, getting more than one insurance product. So you can see the premium per customer has gone from $177 to $266. So significant growth in number of customers and the amount of insurance they're getting with Lemonade. And that's their goal, is to have a bundled offering over time, resulting in a dramatically increasing in-force premium. So the number of premiums they've written, and you can see how that's grown from 114 million to 380 million as of the fourth quarter 2021. So they've certainly grown very, very quickly. But note that in-force premium is significantly more than their actual revenue. This is because they use reinsurance or rely on other insurers to underwrite part of their business. This allows them to write more insurance, then send that business to their reinsurers, and this allows them to grow their business faster. Long term, if Lemonade is able to prove their profitability, get their business to scale, I suspect they'll use less reinsurance and keep their underwriting for themselves. So why is the stock getting crushed and down nearly 90%, nearly 90% from its 2021 high? Arguably, valuation is a huge component here, and that's why valuation matters. But there's actually a few more reasons beyond that. First, they announced the acquisition of Mile. While Mile rounds out their insurance offering with a data-driven car insurance approach, i.e. it's a pay-per-mile-driven approach, the deal is an all-stock transaction. So this, by having an all-stock transaction, it increases the amount of Lemonade shares outstanding. So you already seem to have weak demand for Lemonade shares. Now you're increasing the supply. That should result in a lower price, you would think, in basic, supply-demand aspects. This deal is expected to close in the second quarter of 2022. Another reason why Lemonade stock has gotten absolutely crushed is because their insurance loss ratios worsened significantly. You can see in the fourth quarter 2021 this huge pickup in gross loss ratios. This was due to unfavorable prior period developments, i.e. things that they previously underwrote turned out much worse than they expected. So they were reserving for certain costs and they didn't reserve enough. And so the costs were more than they expected. So i.e. otherwise known as bad insurance underwriting. And as you think about it in insurance business, and Warren Buffett has been talking about this literally for decades, the reality is growing an insurance business has never been a problem. The challenge is growing profitably, and that's going to be a big challenge that Lemonade, I'd argue, not only will face in the future, but faces right now. Now, keep in mind, this is just their insurance gross profit equivalent metrics that I was just showing you. They still need to cover sizable operating expenses, which pulled their results to a $70 million net loss during the fourth quarter of 2021. Worse, management is guiding to a significant deceleration in their growth from around 78% growth in in-force premiums to around 42% growth, where you could see in-force premiums of 530 to 540 million for the fourth quarter of 2022. That's what they're guiding to. This does, however, excludes the Mile deal. I'll save that. Maybe I'll do a revisit after that deal closes. So, and this is all while expecting this deceleration in growth, all while expecting huge losses of 275 million to 290 million negative adjusted EBITDA. Okay, so where does Lemonade potentially go from here, given that the stock has gotten so hammered? Is there a potential bottom for it? First, a quick plug where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies for both good and bad times, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com. Click Join the Journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's unrivaledinvesting.com. Click Join the Journey. And if you enjoy videos like this, please make a point of hitting that subscribe, hit that thumbs up button. So as you look at Lemonade, try to figure out what does their profitability potentially look like long term. Why not look at a mature business like Geico, the auto insurer, a subsidiary of Berkshire Hathaway, where they break out their financial details. Geico is a gem. It's an exceptional business. This is an car underwriting, car insurance business. They have between, let's say, 5 to 10% operating margins on their premiums written. So maybe that could be more over time, but this does show you over the last 3 years, that's their ballpark profitability pre-tax basis. So this could give you a framework for how to think about Lemonade long term, given that Lemonade is nowhere near these profit margins. And keep in mind, their scale is like sub 1% of what you're looking at here from a Geico perspective alone. Now, Lemonade also has around $1.1 billion in cash and investments on their balance sheet. If they burn around $300 million in the next year, that does create the question of will they need to raise more money? Because keep in mind, yes, you do have that $1.1 billion, on the balance sheet, but you also do have a real liability in these insurance premiums, that you've written. You're going to need to be able to hold, significant, offsetting, cash position just to say, hey, or offsetting investment position. So that 1.1 billion isn't truly, free to be distributed. That 1.1 needs to factor in that they need to have a certain cushion that they could have. So if you have cash burn of 300 million, let's say next year, will they need to raise more money? I don't think so for 2022, but maybe in 2023 or 2024 if their losses don't improve significantly. Now, does this mean, and could this increase the risk that Lemonade issues even more stock, a lot more stock at depressed prices? Yeah, absolutely. And that does create sort of this death spiral dynamics for a company like Lemonade, where you have sort of this forced dilution, even if you are growing very quickly. And that is a concern. Now, thinking about the valuation, excluding the Metromile deal, until once again after it closes, if Lemonade can reaccelerate their growth and swing to a profit, or at least prove that the long-term profit is a viable approach, that they can get to long-term profitability, that is viable. So they need to do two things, I'd argue: reaccelerate growth and prove that profitability is viable long-term. Then I'd say Lemonade stock could have huge upside potential. But that's two big ifs: growth and profitability. If both those things happen, then maybe over the next 5 years, 300% upside. That said, I think that's a huge, sort of risk. If they don't, between additional dilution and continued losses, the stock could easily keep getting hammered way worse than what I'm penciling out here. This is sort of hey, let's prove that you can get to profitability. And how profitable can you get? Can you get to, let's say, 10% profit margins? If you're only like, oh, you know what, we might only be able to do closer to 5%, that would be a problem for them. Now, of course, this is just a hypothetical framework. Of course, the stock price can go higher and lower, as it clearly depends on management's execution and market sentiment. Personally, I'm looking at Lemonade's story. I think it's too early for me personally. I'd absolutely love to hear your thoughts. At some point, I would be open to it if I see management delivering on, let's say, continued strong growth, let's say, 40% plus growth in the years ahead, year in, year out, because they're tackling this huge opportunity. They should be able to continue hyper growth if they have a business model that indeed does work, resulting in, lower cost underwriting, and ultimately better service for their customers. And so you look at this, and if they can deliver that better underwriting and arguably better profitability long term, much better than they currently are with huge losses, then it could be interesting. And when you look at a story like this, when you look at a company like this, I think it's really important to reflect that you don't have to catch the absolute bottom. At least that's my personal approach. As I'm looking at my journey, my own investments, is that I will consider teaser positions in companies where I'm like, you know what, you haven't proven yourself out yet. But for full bigger positions, I'd say, oh, okay, you've already proven that the thesis is here. You're already profitable, or you're already at a very, you're at 1% margin and you think you can get to 5. That type of story I can get my head around. And then it's about, oh, you're tackling this huge market. Let's see you grow. And so that is a type of position that I'd be more inclined to say, oh, yeah, let's make that a full position. I will consider teaser positions in speculative situations. At this point, I'm still not quite there with Lemonade, but I'd be open to it to see them continue to make progress with those initiatives. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.